Welcome back to another episode of the Walk of Wealth channel, where we help dentists and professionals achieve true financial freedom through passive investment in real estate and other alternative assets. Today, we are going to be diving into one of the most powerful but often overlooked wealth building moves that you can make. And that is converting an IRA to a Roth IRA with novel strategies that produce little to no income tax liability. This creates the ultimate IRA strategy where all gains thereon after grow completely tax-free. Now, I'm joined today by someone who knows the ins and outs of this whole process, and he goes by the name of Mr. Casey Stratton of Tamarack Capital. Casey, thanks for being here today.
Thanks for having me on, Dr. Johnny.
Absolutely. So Casey and I actually we're both part of a mastermind member. It was a real estate entrepreneur mastermind member called Capital Collective. We didn't cross paths, but through mutual mastermind member connections, we were introduced to each other. And I'm very excited about this strategy. It's a very novel strategy, one that I haven't heard about before. And it's very powerful because if we know anything about a backdoor Roth IRA, and for some of you guys might not know what that is, but Casey's going to get into that today. And this allows you to make investments, right? The ultimate goal of this is that you can take your retirement funds, make investments, and all gains are tax-free forever. Not deferred, not, hey, I'm going to pay a big chunk of taxes at the end, but all gains are tax-free. And even when you withdraw the money at 59 and a half years old, you can withdraw tax-free. All right. So now, now I know that sounds really amazing, and it is amazing. These are strategies of the really wealthy and the really savvy. But Casey, why should we listen to Casey? Well, Casey is a seasoned investor, right? He's with over a decade of expertise in real estate investing, and has been a general partner on over $200 million in commercial real estate deals. And today, Casey is pairing his background in investment finance and the legal industry to develop an IRA investment fund that allows investors to roll their IRA into a Roth IRA or backdoor IRA while minimizing their tax impact of the conversion. So without further ado, Casey, I'm going to let you take it away. Explain your strategy, and then we'll go from there.
Wonderful. Well, I'm going to start off explaining why people should care on a very high level perspective, and then we get into the presentation. But for those of your investors who know what an IRA is, you contribute that money pre-tax. So all of your money goes in, you're not paying tax on, and it grows tax-free until you take the distributions out. And that's when the tax man comes. Conversely, you can have a Roth IRA where you put money in on contributions that have already been taxed. And then all of that grows tax-free, and then you take that money out tax-free. But at either end, the tax man comes, right? Well, there's a saying called an IRA conversion, where you can take an IRA with the pre-tax money, roll that over into a Roth, and you pay tax on the amount that you roll over. Our strategy here is minimizing that fair market value and that tax liability at rollover, so you can potentially have a IRA where you don't pay money on the tax coming in, you pay minimal to no tax on the conversion, and then all that grows tax-free and you can withdraw tax-free. So let's get into that. This is a strategy that really puts together two principles in a very novel and unique way that's hard to do, but which creates huge tax saving benefits. And I'll say on this right now, I've had the fun strategy in my head for about 10 years, but it's taken me 10 years to put together the expert strategic partnerships and investment vehicles to actually make this something that we can execute and bring to our investors. So with that, Johnny, how's my screen looking? Is that coming up nicely?
Looks good, yep.
Okay, great. So I'm Casey Stratton. I'm a managing member of Tamarack Capital, and this is our IRA conversion fund. So first, everyone has a disclaimer. I think it's especially important to have a disclaimer here because this is novel tax advice. Right now, we're talking about the concepts and strategy. I'm going to get into this a little bit more later, but as the final part of our feasibility, we have engaged with one of the big four accounting firms, and we're spending close to $50,000 on an extensive opinion letter where they're going to go in and validate and form an opinion on all these concepts that we already know are complying with the Internal Revenue Code. But in putting it all together, we want to make sure we covered all our bases. So we're investing quite a bit on the final feasibility push. Again, any investments that come out of this will have PPMs, talk to your tax professionals. Right now, we're just educating on concepts. So at Tamarack Capital, I got into this because I saw that from myself and a lot of my business partners, people either grew an immense amount of wealth from real estate, or the people who had outside businesses or wealth from other means use real estate as a defensive posture. And I saw so many people in my peer network, my friend groups, family, who didn't know how to even get started on real estate investing, or they didn't have the time. And so we really believe that anyone who's trying to achieve financial health should have some real estate in their portfolio. And we have a mission of bringing those opportunities to our group. Go over this pretty quick. Right now we have three partners. Myself, I work on the acquisition, investment strategy, and a lot of the working with our investors. Max Schneider handles our operations and asset management. And then Tori Azure is our newest member, working on marketing and investor relations. So at Tamarack, we have a number of different products. We range everything from a little bit lower risk, an income fund where investors who want to get 9 to 12% annual returns can invest in this. They're lower on the capital stack. They get more predictable income, less upside. Our bread and butter really is multifamily value-add syndication. We're also in development, but we're here today to talk about the newest product, the IRA conversion fund. So with that, kind of alluded to this already, but here you can see on the left, we have your traditional IRA. Pre-tax contributions go in, grow tax-free, but then you pay income tax when that money's distributed. Likewise, the Roth IRA, it's you contribute with money that's already had taxes paid on it, but then after that, everything grows and you can benefit from it tax-free. You also have the third strategy of rolling over your IRA to a Roth, and you pay income tax on the fair market value of that conversion. And this is a really important concept here, where it's the fair market value. And so then we get into what is fair market value and how does that compare to net asset value? Net asset value is the equity you have in an investment. So you take the total asset value, subtract off any liabilities on it, and that's your net asset value. So if you go in and you buy $1 million building and you have a $7 million loan on it, your net asset value is going to be $300,000. 1,700,000 liabilities, 300,000 is your net asset value. Fair market value is slightly different in that it's purely what a willing buyer and a willing seller would transact at if both were seeking to get the best possible price. And we're going to get into why those are not exactly the same in a minute, but on a real simple example, if you have an IRA with, say, $100,000 invested in the S&P 500, and you roll that over to a Roth, you're going to have a net asset value and a fair market value of $100,000, and you're going to receive a 1099-R form at the end of the year from your Vanguard or custodian saying you have additional income of $100,000. When you have publicly traded assets, by definition, the fair market value is what the public is transacting at, and it's very simple to understand. It gets more interesting when you get into a private investment. So let's just go back to that IRA owner who has $100,000 and they want to invest into a private real estate syndication. At the get-go, day one, their net asset value is $100,000, right? The syndication is going to buy a property, they're going to have debt on it, and then the equity that those limited partners have is going to be their net asset value. But it's not the fair market value at that time. And a simple way of understanding this is, Dr. Johnny, if I'm going to give you $100,000, would you prefer if I gave it to you in the form of $100,000 in cash, or $100,000 I just invested into a business that you don't control, that you can't get your money out in the near term? It's got a 5-year lockup period. Which would you rather have?
I want the cash.
Yeah, I think most people would say they'd want the cash. And this is the general principle of why fair market value is lower than net asset value for private investments. It's because of these things called discount factors. So what is the discount factor? These are things that, like we just talked about, reduce the perceived value of an investment. When you come in as a limited partner into a real estate syndication, that money, your investment, is all tied up in equity in this apartment. You can't sell apartments quickly. There's high transaction fees. It's a non-liquid asset. So that LLC really has no form or method of cashing you out if you wanted to. It's not liquid. Likewise, there's not a ready market if you wanted to go sell your interest in this syndication. I know I've dealt with this. I'm sure others have dealt with this. If you need your money out of a syndication and you go try and find another buyer, you got to incentivize them to buy your interest out of that business. That's called lack of marketability. And the third main one is lack of control. The LPs have no ability to have decisions on when distributions are made, when to refinance, or when to sell. They're just along for the ride and trusting the general partners to make that decision. Well, this is exactly what we see in real estate syndications. And the reason why people are willing to deal with these drawback factors is that they expect to get an outsized return down the road as the general partners execute on that business plan and seek those returns in the 15, 20% ideally. So we've seen this where you can go and actually get an independent business appraisal. So it's not a real estate appraisal, it's a business appraisal to value your interest in a syndication LLC. And the data shows that depending on circumstances, that discount factor can range from 30 to 45%. And I like to point this out because it's interesting. The Internal Revenue Code actually clearly defines, and they make you assess the fair market or the rollover value on fair market value, not net asset value. But when you flip the script here, if you're making a charitable donation, the IRS says, no, your tax write-off is the fair market value, not the net asset value of your donation. So the IRS kind of make sure that it's applied evenly both ways, whether it's a deduction or a income tax liability. So let's take this same rollover strategy to a real estate syndication. The investor contributes $100,000. Maybe a year later, they want to roll over to a Roth IRA, and they get an appraisal done by a third party, and they say, well, your interest in this investment is worth $70,000. Well, when they roll that over, they're now going to get that 1099-R income tax form from their custodian, and it's going to say $70,000 rather than the $100,000 originally invested. And that's nice. If you look at it from what's your effective tax rate, if you normally pay 40% and you discount that by 30%, you're now at a 28% effective tax rate. So a reduction of 30% in your tax liability is nice, but I don't think it's motivating enough for people to directly execute on this rollover. The second part of what we do to amplify this is we bring in leverage. And so this is where it gets a few steps more complicated. So stop me if I gloss over anything that's tripping you up here. Mm-hmm. Our goal here is to use discounts and leverage to reduce that tax liability as much as possible. So let's look at a case study here where we still have that same $100,000 IRA, but then they borrow at the IRA level $200,000. And we're going to use the same assumption of a 30% discount factor, which is on the lower end. So let's walk through what this could look like. $100,000 in cash. The IRA borrows $200,000. So you have a total net asset value of $300,000 in the IRA. That IRA then invests $300,000 into a syndication. So their net asset value is $300,000 in the syndication. Down the road, they get an appraisal and they come back with a 30% discount. So $300,000 discounted by 30% creates a fair market value of $210,000. But you still need to subtract off that $200,000 in debt. When you do that, you get down to a $10,000 tax liability. So we took $100,000 and are rolling it over to a Roth IRA at a value of $10,000. And I'm using broad strokes here, simple numbers. You're over a year, your net asset value could go up a little bit. Your discount factor could be higher. Leverage could be tweaked up or down a little bit, but you can see from these basic principles, we could effectively get that down to zero. And so that creates a very efficient way to convert your IRA to your Roth IRA. So, and again, this shows a very simple thing. We had our same situation here where we get that $100,000 over to a Roth IRA with a fair market value of $10,000. So what would an IRA conversion fund look like in practice? It's structured very much like a traditional syndication. There's going to be your general partners. There's going to be your limited partners who are investing the capital. The main differences here is that there's going to be an IRA lender brought in to create that $200,000 loan to your IRA. And because your IRA is levered, we would want to be having a deleveraged acquisition on the underlying asset. You wouldn't want to have leverage on top of leverage. So this is a bit unique where we might be coming in with 30 to 50% debt on the underlying asset and relying on the IRA level debt to get us up to a traditional leverage amount. So other than that, they're fairly similar.
So this is because you're coming in on the debt side then, right? Versus the equity side. As the IRA, you're lending. Are you the lender to this project?
No.
Equity coming in as an equity position.
Great question. Yeah, the IRA is borrowing $200,000, so you're going to have $300,000 in total cash to invest as equity into the syndication.
That it. And you're saying that that with this investment offering, you're using low leverage, so that way you're not having too much, debt leverage on top of leverage, basically. And you're saying 35 to 50% LTV.
Yeah, and these are some things that we're still assessing out there, but yeah, basically, I mean, you can imagine if this was leveraged normal 75% debt. And then let's just say this was leveraged 50%. Well, now this investor's effective leverage is like 88%. And that's, in my head, too high to be responsible with people's IRAs. So I would advise against it. And we're just trying to create the underlying investment offering that is deleveraged. You almost could, I can't think of any syndicator out there who has put out an offering with sub 50% debt on it.
Yeah, I mean, one of the biggest reasons that we are real estate investors is that leverage used correctly can really amplify returns, right? So I would assume that the opposite is true, that hey, we're taking on a lot of equity and we're not taking on too much leverage, which de-risks the deal, right? Reduces the risk, but it also reduces the rate of return tremendously, right?
Right. And so we set this up so your global leverage between your IRA and the investment is at industry standards of around 70, 75%. So, okay, this sounds great. What are the risks and why isn't this out there more? Well, I would say first, and I see this as a minor risk, the strategy follows all the Internal Revenue Code, but the IRS could push back on the amount of discount applied to the fair market value. And this is extremely important why we use third-party appraisers. We want to make sure that we have a independent, data qualified, unpassionate assessment of what the fair market value is. Obviously, this is not an investment that you would want to have someone who doesn't want exposure to real estate to make, right? There's a lot of people who are at certain stages of their lives where they're playing more defense than offense, and this is not suitable for them. Probably the most important is that this takes numerous strategic partners. And this is why I've spent 10 years and really the past year aggressively putting this structure together. You need to have appraisers that you can refer your investors to who understand that they're appraising a business and not real estate. So whenever we're in this industry and you think about appraisers, they're like, okay, let's look at get a broker's price opinion or something like that. Self-directed IRA custodians, we work with a custodian that we really like. I have my own personal money with them, and we try and make it very smooth and seamless for our investors. I'm going to skip IRA lenders for a second. You also need unleveraged real estate syndications. That's what we're bringing to the table here, and that's a bit unique in the industry. But going back to the IRA lenders, this is one of the most difficult parts to put together. And it comes down to IRS limitations on how IRAs can borrow. I think many of your investors might know that IRAs cannot, like IRA owners, so the individuals cannot personally guarantee the debt that their IRA has. That's a disallowed transaction, and it's going to invalidate your IRA, a big no-no. So then what do you have as collateral for the IRA? Well, there's a cottage industry of lenders out there who will lend to an IRA that's buying, say, a fourplex, and it's not buying it through an LLC syndication. It's just directly on title. Well, then that lender can lend to the IRA, collateralize the asset with the fourplex, and everyone's happy, right? But the complexities in here is that to get the fair market value discount, you need to be in a syndication. And if you're in a syndication, there's no way for this IRA loan to be collateralized by the underlying asset on title. So we're creating a special lending program to address this problem. And that's been one of our bigger challenges. And then lastly, we went through a lot of concepts that are backed by an understanding of a lot of Internal Revenue Code. And I can tell you, most syndicators are barely qualified to even be syndicators. They sure as heck are not experienced or knowledgeable enough to talk about Internal Revenue Code and advanced tax strategies. Most of the people who are going, understand these advanced tax strategies are working with family offices and ultra high net worth. They're not working with retail investors. So that's where we're at, is we find this dislocation in the market where we can come in and help bring advanced tax strategies to the retail investors, the medical professionals, the working tech professionals. We just don't think that it should be exclusive to the ultra high net worth. So yeah, with that, next steps for us, like I said, our last step is to get the opinion letter back from one of the big four consulting firms. We are spending a lot of money to make sure we're going with the best in the industry, because we know that our investors are going to be saying, okay, Dr. Johnny, Casey, is this for real? And we want to have the best piece of paper to show them, for you to take to your CPAs, to understand what is valid about this. And if there are any risks, let's identify and call them out so you can make an informed decision. We're also finalizing the last of our strategic partnerships that we need to pull and make this work. And we're at the early stage of reaching out and engaging with investor marketing. And we see a lot of value in this, but we also are very eager to connect and start getting feedback from potential investors on what they see, their excitements, their apprehensions. It's a two-way conversation here. And we're targeting a launch in Q1 of 2026. So, stay tuned with Dr. Johnny. I'm sure we'll be back as we progress through this more.
All right, Casey, that was a very informative discussion. Thank you so much. It looks like you're democratizing, access to these advanced tax strategies, so that doctors and dentists and business owners can also take advantage. So I think this is a very exciting, first of all, completely novel strategy to me, probably most of the people that are watching this. So very excited to see as this progresses. If you guys want to, follow along and are interested, follow us on our website. We're on the website. It's in the description below. If you want to work directly with us in our mastermind group, that's also in the description. The link is in the description below. Casey, we will bring you back on again in about 6 months or so. You can give us an update on what's happening, and we look forward to seeing you there.
Absolutely. Thanks for having me on. And my goal is to make talking about the Internal Revenue Code exciting. So hopefully we achieve that.
Good. Thank you so much.